In a 2013 paper, EDIC researchers described a set of widely held beliefs about infrastructure investments and the nature of the business model of infrastructure companies. They called it the infrastructure investment narrative. Because they provide essential services, infrastructure investments are expected to exhibit low volatility of income and low correlation with the business cycle. They're also expected to generate steady and substantial cash flows for their owners. While this story is intuitive, it has also never been tested empirically, until now.
With this paper, we wanted to test the idea that infrastructure firms have a unique business model compared to the rest of the public and private firm universe. We wanted to test whether infrastructure firm revenues, profits, and dividend payout policy were different compared with other firms in the economy. These factors will play an important role later in our work when it comes to pricing private infrastructure assets.
We categorize infrastructure firms by business model into firms that receive either contracted, regulated, or merchant income. In this paper, we focus on UK data to hold currency, tax rules, and regulations constant, and because the UK offers data going back more than 15 years. The EDIC Infra database yields the following 3 families of UK infrastructure firms. Next, we collect data about private and public firms active in other sectors of the UK economy, and build 3 control groups corresponding to different corporate ownership structures.
当有了3组基础设施公司以及各自对应的非基础设施对照组的数据以后，我们可以用 KNN 算法来将它们进行配对，从而控制公司规模、杠杆率、利润和营业年限，这些也可以用来解释企业派息行为的变量。为此，我们开发了一套独特的方法来计算倾向分数和匹配这类数据。得益于这套方法，我们能够为每一组基础设施公司建立一个相应的对照组，由此产生的匹配对照组和对应的基础设施公司的相似度是非常高的。现在，我们的对照组和对应的基础设施公司的相似度就非常高了。
To compare income and profits across firms, we scale these variables by firm size. We divide revenues and profits by the average size of each firm's total assets during the period of observation.
So, what do we find? Infrastructure firms have considerably lower volatility of revenues and profits. On this plot, the blue dots represent the mean volatility of revenues for the average contracted infrastructure firm at each point in the first 15 years of its life. The other colours represent the same information for the 3 control groups of private and public firms. Clearly, infrastructure is in a league of its own, and we find similar results for all 3 types of infrastructure business models and their respective control groups. Next, we check whether the business cycle has any impact on these cash flows.
To compare the impact of the business cycle on the revenues and profits of infrastructure and other firms, we use regression analysis. We proxy the effect of economic cycles with 4 different measures: a GDP index, the retail price index, stock market performance, and whether or not the economy is in recession. We don't find much contemporaneous relationship between our 4 proxies of the business cycle and infrastructure revenues and profit rates, whereas the control groups are all correlated with the business cycle with a high degree of statistical significance. It's not like infrastructure firms have no revenue or profit volatility, but the factors that explain these variations are mostly unrelated to the business cycle. Finally, the paper asks how likely the dividend payouts of infrastructure are compared to other firms, and how large. Firms pay dividends more or less frequently. For example, we know that listed companies, once they start paying dividends, tend to continue doing so even when their income varies. We also know that dividends follow the firm's life cycle, especially in the infrastructure sector. If equity is really subordinated debt, as is often the case in infrastructure, then dividend payouts should be less discretionary. The size of dividends is also an important question. Companies that have the freedom to reinvest are more likely to refrain from distributing their free cash flows to shareholders.
To understand the dividend payout behavior of infrastructure and other firms, we first estimate the probability to observe a positive dividend, and then the expected value of their payout ratio when they pay dividends. We find that infrastructure firms are much more likely to pay dividends than their non-infrastructure counterparts, even in bad years, and that their expected payout ratio is considerably higher than any comparable public or private firms, irrespective of their corporate governance structure.
So in the end, we find that infrastructure firms truly are different from other firms. They have low revenue and profit volatility and higher cash payouts relative to total asset value. Most of the volatility in revenues and profits is explained by business model and firm life cycle, and the impact of the business cycle is only felt after several years, if at all. We also see very distinct dynamics within each family of infrastructure firms. For me, this has important implications in terms of asset pricing. It means that infrastructure firms can diversify other investments while creating their own sources of remunerated risk exposures.
This work is ongoing. EDIC Infra continues to build the largest database of infrastructure cash flows available for research in the world. Combined with this unique data, the matching techniques we have developed can be used to test other ways in which infrastructure firms might be unique. Applications include identifying common factor exposures among infrastructure investments, building listed proxies of private assets, and continuing to explore the differences of behavior between infrastructure and other firms in the economy.